Welcome to The Grasp. I'm Doug. Today we start our series on technical analysis. As I have mentioned previously, this is a long-term project. I probably have hundreds of hours of information that we're going to provide, but we'll try to keep them short and in bite sizes so that you'll get everything. So buckle up and let's get to it. Before we get started, I have to say, of course, this is not financial advice. This is for educational and entertainment purposes only. There, I've said it.
Everybody got that? Good.
Now right here at the very beginning, I want to make a couple of points. When we're talking about technical analysis, we are talking about a mathematical/scientific look at markets. And one of the things that we need to realize at the very beginning is that when we are talking about markets, we are talking about people. Markets are living and dynamic. And so whether you're talking about the stock market or cryptocurrency markets or bonds or whatever, you're not actually trading stocks or bonds or cryptocurrency per se. Because if you're on the stock market, yes, stocks are trading hands, but stocks aren't doing that on their own. People are buying and selling those markets. So what technical analysis is really doing is looking at crowd behavior. The best way that I can describe this in a way that I think everyone can understand would be driving in your car. There is no way to know what any single individual is going to do because people are random, right? But when we look at it in crowd, like crowd behavior, there are specific patterns that develop. For instance, if we're driving down the highway or down the parkway or down a major thoroughfare and there's a wreck and traffic starts to back up, well, I don't know necessarily what the guy right in front of me is going to do, but as a general rule, looking at crowd behavior, if there's a traffic accident here, what do you think people are going to be doing? Well, everybody's going to start looking for exits, ways around it, right? We start trying to get on access roads and things. And you can look at that from above and it's extremely logical, right? Because very few people want to just sit there for an hour while the police and the wreckers come and clear it. So everybody begins to look for ways to get around it. That's crowd behavior. And you can kind of think of technical analysis as the same thing. We look at crowd behavior in the markets based on price movements, and then we can make decisions based on what we believe people as a group are going to do.
Pushing people, huh?
One more word of caution or advice that I'm going to give, and I'm probably going to give this often throughout this whole series because it's important to remember. Technical analysis is based in math and science. That is true. Technical analysis can be a fairly accurate way to look at behaviors and make decisions off of that. That is also true. But here is the problem with technical analysis. As you get into technical analysis, as you get more comfortable with it, you have a tendency, it's a human nature thing, people tend to think of it as flawless, that I see this pattern setting up, therefore I know for a fact that this is going to do this in a behavioral way. And here's the problem with that, is that anything can happen at any time. And let me give you a story to illustrate it.
If we could speak seriously for a moment.
There's this technical analyst, and he is excellent. He is a very, very, very good technical analyst. And this old trader, this old cotton trader, has contacted him to try to teach him technical analysis because the old trader didn't trade based on this new scientific method, right? He just was an old trader. He kind of knew the markets and he traded in a different manner, and he wanted to learn this technical analysis thing. So this analyst sits down with him and is walking him through all this stuff, and they're watching the markets flow, and cotton is dropping and dropping and dropping. And so the analyst says, okay, based on these charts, based on all this, this is the bottom of the market right here. And the old trader looks at him and says, this is the bottom of the market? And he said, yes, it won't go any lower than it does now. It's going to bounce from here. And the old trader picks up the phone, calls the broker and says, I want to dump 1 million bushels at market. And of course, at that point, the whole market just collapses and falls. And the analyst is just shocked and horrified. But this is the point. Anything can happen at any time. That trader, the analyst may have been correct that based on the technical analysis, this in normal events, this may have been the market and it should have bottom of the market and it should have bounced from there. But this one individual, proving him wrong, goes in and calls for this flooding of the market with the cotton bales. And here's the issue, that can happen at any time for any reason. We don't know that.
Are there really giant birds like that? No, that was all just special effects.
So the whole thing about technical analysis, we are playing probabilities. Here's my warning. When you get into technical analysis, the further you get into it, the more comfortable you get with it, the more study you do, the more that you see these patterns work, the more all these things happen, it tends to be human nature to eliminate the idea that it's just probabilities and that anything can happen, because we get so comfortable seeing these geometric patterns or these things set up in shape and form, and therefore we think, therefore the market has to do this. At any time, anybody in the whole world can do anything that will affect that price. We don't know anything about news cycles. You never can tell what is going to happen. So what you always have to remember is that technical analysis is simply playing probabilities. That's it.
I've got it.
So here is a foundational question. Why do prices move? What makes the market move the way that it does? As I have mentioned, one camp, the old camp, would be based in fundamental analysis. We're going to look at price to earning ratios or market capitalization or book value or ROIC or any of these other factors where we would take a look at some type of data from that company to make a decision on what is this company actually worth. Those things have some value, but they don't actually determine why prices move. And let me give an example. So let's say that a company comes out, Tesla, and they say, hey, we're going to introduce this new model of car. And therefore the price of the stock just starts to skyrocket. Well, why? The car hasn't been produced, none have been sold, right? No money has actually increased. It is an expectation. It is somebody's thoughts about what that company is going to be worth down the road based on this new information. But that actually hasn't changed the actual value or the balance sheet of the company today, and yet the price moves 5 or 10 or 20%, right? So fundamentals don't actually move the market. Now you can use that information, especially in a long time frame. If you're going to buy and hold something, you can kind of use fundamentals to gauge what the actual value of that company is, if it's heading in the right direction. Those are types of things that are useful, but they don't move the market. They don't move prices. And so we have to figure out what does move prices. And of course, that is emotion. People. We're trading markets, so people move the prices. Expectations. If that announcement comes out, the people get excited and they're willing to go throw money down on it, and that drives the price up. So the same thing happens if some bad news comes out and people begin to panic and sell, then the value of the price of the stock crashes, even though technically the value of the company hasn't changed any. So markets are moved by emotions, and so we are in technical analysis looking at the flow of money to kind of determine what is happening in a crowd type behavior situation.
I hate everything you just said.
So we live in an age of continuous flow of information. Information moves globally faster than it ever has in our history through apps like Twitter or Getter or YouTube or Rumble, and you see all these different sources of information constantly flowing on a 24-hour cycle. That's never happened before in the history of our world. So information moves quickly, and information moves the market. And so this continuous news cycle that's constantly going, constantly is adding inputs into people's emotions, which moves the prices of our underlying investments, whether that's stocks, bonds, or cryptocurrencies. Now, is all of this information accurate? Absolutely not. Does that matter? Absolutely not. Especially in the crypto space, we've all heard of FUD, right? Fear, uncertainty, and doubt. There's all kinds of misinformation. There's all kinds of political information or competing information from other chains that are constantly out there trying to affect prices. And all of that information does affect prices. So we have to remember, as I mentioned earlier, there's always a little circle here of uncertainty that we have to keep in the forefront of our mind. Because we can see prices set up, we can see things move, but anything can happen at any time that can affect prices. So you have to kind of keep that in mind.
Fine.
So our goal as technical traders is not to be emotional. We aren't emotional traders. We're trying to eliminate the emotion out of our trading business because that clouds our thinking. We want to be clearly, logically thinking, looking at information, and objectively seeing what's happening and not being emotionally attached to things. So that's kind of what our technical analysis is trying to help us accomplish. We're trying to overcome emotional trading.
Your report had better be something very special.
That's all for today. Next time, we'll dive right into technical analysis and start looking at oscillators. Until then, we'll see you back here on The Grasp.